So what is important for us is to understand that now a higher high is formed because this higher low is formed, and the time frame that you are in, it is important. So we expect a pullback after a break of structure. We expect a pullback on that time frame. Okay, so if you drew, let's say, but we'll go to it when you see the charts. If you have a break of structure on the 4 hour, you expect a pullback on the 4 hour. Okay, if you draw, you see a break of structure on 15 minutes, you expect that break of structure pullback to be on the 15 minutes. And even when you take your profits, it will be based on the 15 minutes, not on the overall trend. Right? Exactly. So now, here below here, I want to show you something. So what we see here on top, right? This is what we are taught. This is what we are taught, that the market moves like this, high, 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 low, like this. It's simple. We expect to see something so nice, so sexy like this. But it's actually, in reality, this is how the market, this is how it's going to be. You see here below.
Yeah.
You see here below. This is how the market is going to be. This is how the market is going to be. The market is not going to flow like this. Sometimes you can get 2 out of 10 times, maybe you'll have a nice flowing market like this. But other than that, the market will be like this. It has to complicate you. It has to mess up with your head. It has to make you think twice. You understand? Remember, what we are trading is called smart money for a reason. It is because you are smart, and is to trade with the banks, right? So the banks will not allow you to take their money, but we want to trade with them. Okay? So now, what's happening here in reality is that this is how the market will be like. If we are in an uptrend, it's not going to be straightforward like this.
No.
So it's going to be like this: higher high, higher low. Still, we have a break of structure, small pullback, not back in the range. Remember, I'll show you when we go to another slide what constitutes a new higher high, because those are kind of things that you must understand, right? Not to say that, okay, this is a higher high and then this is a higher low. You need to understand, okay, what really constitutes that higher high? Why makes it a higher high? Why should we take the Fibonacci from this higher low to this higher high, right? You understand? So now, when we go in here now, we can see that, okay, we have this break of structure, a small pullback, a higher high here is formed because now we have this push which breaks the market, right? It breaks this previous pullback. So here now we have a change of character, sort of a type. We'll talk about it later. We have a change of character. So this now we can say it's a pullback, because now on this higher high, what we wait for on this higher high is a change of character on the smaller time frame for us to say that it's a pullback, and then it will come back, and then we don't expect it to break. If we're in an uptrend, we don't expect it to break this previous higher low, right? Because if it breaks this, now it's changing, excuse me. Okay. Okay. Okay, let me just, okay, no problem. All right, sorry about that. All right, so now what we can see here is that we have this higher high and a higher low like this. So do you see how this market was moving here? It's busy forming liquidity and doing all those kind of stuff. But then at the end, it forms a higher low, and then now it forms a new higher high, higher low, break of structure. But inside is complicated. Even on the bullish, bearish market, it's still the same thing, right? It's not straightforward. So now, we're going to move on now. We're going to be talking about what we call swing highs and swing lows, right? We're going to be talking about what we call swing highs and swing low. So what is a swing low and what is a swing high, right? So you will find swing lows and swing highs, right, in a trending market, right? You'll find this in a trending market. So now what's happening here? A swing low in an uptrend, okay? A swing low in an uptrend. It is the lowest point that lead to the swing high. Let me repeat that. It is the lowest point that lead to the swing high. The lowest point that leads to the formation of the swing high, basically. That is what I'm saying. The lowest point. The lowest point that leads to the formation of the swing high. That is the swing low. So the lowest point that leads to the formation of the swing high. You get it?
Yeah.
The lowest point, that leads to the formation of the swing high. So this is the lowest point leading to the formation of a new swing high here. Just broke structure. We're going to have a new swing high.
Yeah.
You understand? So this here, when we are talking about a swing low, this one here, let me quickly, but you can see my mouse, right?
Yeah, I can see it.
Okay, good. This one is not a swing low. This one here is not a swing low, right? Don't be confused when the market is doing this. This one here is not a swing low. This one here is not a swing low. But these two, they are used for other things. We'll tell you later on. But this is not a swing low. This is not a swing low. Our swing low is the lowest point that leads to the break of structure. The lowest point that leads to the break of structure. We get the concept. Then the swing high. What is a swing high? We have swing low. We understand that it is the lowest point that leads to the swing high. Then swing high, it is the highest point that lead to the swing low. It's vice versa. Do you understand? So that's why we have swing high, swing low, swing high, swing low. They work together. So the swing high is the highest point that leads to the swing low. So it's the highest point which leads to the lowest point, basically. That's what they're saying.
Yeah.
Because on the swing low, they said it is the lowest point that leads to the swing high. So here, the swing high, it is the highest point which leads to the lowest point. That is basically what they're saying. So, yes. So we have a highest point leading to the highest, to the swing low, right?
Yeah.
So highest point leading to the swing low. So it's highest point leading to the lowest point. Still the same thing, okay? So the same thing applies on the bearish market. A swing high is the highest. Oh, sister. Yeah, let me see. Okay. So a swing high is the highest point that leads to the swing low. Highest point leading to a swing low. But here, what will be the difference is that you know that here will be higher, 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 low, higher, higher. But then here you know that we're forming lower lows and lower highs going down, right? Yes. But then the swing high, swing low is still the same definition. Swing high, swing low, still the same definition, right? So it's the highest point that leads to the swing low. And then the swing low of here is still the lowest point that leads to the swing high. Basics. So you can get that. If you can get that, I'm telling you, you will go very far. You just need to understand the basics of market structure. That is what market structure is all about. Those are the basics, okay? So now let's take it a bit deeper. We're going to be talking about ranging markets, our swing highs and swing low. We understand that now. We understand that we have what we call swing high and swing low, right? But then now, what do we call this? This is what we call internal structure. Okay. This is what we call internal structure. So that's why I was saying that this is not a swing low. This is not a swing low. This is an internal structure. So what happens in an internal structure is that basically what happens here is that we have our swing low, swing high, swing low, and then we have our swing high. Then here on the internal structure, it's everything that is happening between the swing high and the swing low. Yes, between the swing high and the swing low. So if I can just show you this price action here is between the swing high and the swing low. So what's happening here? It's forming what? Internal structure. This is internal structure. So between this swing low and this swing high, where's our internal structure? It's here. You see? So going down, now here we have our swing low and we have our swing high. Then from here, what we have, this is what we'll be trading, which is called our swing range, right? This is our swing range. This is what we'll be trading. So if we have, let me go back before I go to this one. If you come here, we have this swing low, swing high, swing low, right? And then we have this swing low and then this swing high. So before this is formed here, This internal structure here, this is our trading range of this swing high and this swing low, right? This one here will be our trading range of this swing high and this swing low. So this means that whatever we'll be doing, we'll be trading between this swing high and this swing low. And if we know the trend of the market, this is where we can counter trend here and sell here, knowing that when the market comes to a certain point that will teach you along the way, when the market comes to a certain point, it will be reversing and going to break that previous swing high, because we know that we are in an upward trend. We know that this is our swing high, this is our swing low, this is our swing high. After a swing high, we expect a swing low which will not break the previous swing low for it to continue the trend. Okay?
Yeah.
So now the same thing applies for our bearish market. So this is where we trade. We're trading in these zones. We're trading in these zones. We have the swing high and the swing low. And what we have where we have a swing range between the swing low and the swing low. This is what we call this range high and the range low. Remember what DK was talking about yesterday? Remember? He said range high, range low. Right? So the same thing here, range low, range high. And then this is the range that we'll be trading in. Right? This is where we'll be trading in. Okay? So this is our trade range. So we can see our trade range is formed by a swing high and a what? And a swing low, basically. It's formed by a swing high and a swing low. If you correctly identify your swing high and your swing low, you correctly identify your trend. Remember, the most important things: trend, structure, liquidity. Then, guys, you are set for life. So if you correctly identify your swing high and your swing low, you have your range, everything else will just follow. All right?
So the trade ranges are actually the same thing as the swing range.
There? Yes. Yes. Swing range and trade range is the same thing, because we trade in the swing range. So it's just a lot of okay. Don't get confused, yeah. Don't get confused. No. I'm just trying to explain something. Like for example, right? Yesterday, DK was teaching break of market structure. He denoted it as BMS, right? He denoted it as BMS, which is still break of market structure. So me, I denote it as BOS, which is still break of structure. You understand? Some people, they will denote it as BS, which is still break of structure, right? So as long as you know what you are seeing and you know what you are doing, so it's for you to understand which one you understand better, right? Yeah, so if you think that trade range will stick better, you can use trade range. If you think that swing range will stick better, you can use swing range. After all, it's for you it needs to be easy for you to understand. You don't, this is not rocket science. Yeah, it's not rocket science. So whatever works, that's what we go with. All right. So now I'm going to introduce the concept called strong and weak highs and weak lows. Right. I'm going to introduce a concept called strong highs and strong lows, weak highs and weak lows. Right. So on this concept, basically what we'll be talking about in a bullish trend, for example, in a bullish trend, we know that the bullish trend will be forming what? Higher high, higher low, higher high, higher low, higher high, higher low, right? And then now, what do we mean by strong highs and strong lows, weak lows, strong highs, weak highs, right? So in a bullish trend, right? When the market now comes in a bullish trend, we know that it's forming higher highs, higher lows, higher highs, higher lows. We are in an upward trend, right? So now in a bullish trend, the highs become the weak highs. In a bullish trend, the highs are weak and the lows are strong. You get it? Oh, you get it?
Yeah.
In a bullish trend, the highs are weak and the lows are strong. Basically. What does that mean? It means that now, remember guys, we are in a bullish trend, right? In an upward trend, it costs a lot of money for banks to put here and break this price and go up and break this price. It costs a lot of money to do that, right? I mean, in a bullish trend, for example, it costs a lot of money here for the banks to break these highs, right? So they will protect this higher low, right? They will not want people to come and take out this higher low because there's a lot of money that they invested here. That's basically what I'm saying. There's a lot of money that they invested here for this high to be taken out. There's a lot of money that was invested here, and they wouldn't wait for price to come and be taken out. Simple like that. So in a higher, because now in an upward trend, we are looking for what? Higher highs and higher lows. The highs are weak because whenever we take our trade, we take our trade in the higher lows, targeting what? Targeting the higher highs is our target. Yes. The higher highs, we expect them to be taken out. Come back to higher low, take out. So the higher lows are called strong lows, right? So what we do, we need to trade. You trade away, right? Remember, in a bullish trend, right? You trade away from the strong lows and we target what? The weak highs. Simple. Simple. So in a bullish trend, we trade away from the strong lows. We take our trades here on the strong lows, and our target is the weak highs. That's it, basically. So the same thing here. We created a new higher high now. We created a new higher high. What did we do? We pulled back, created a higher low. We did not break the previous higher low. We are still in an upward trend. And then now we enter our trade here. Where's our target? The week high. Yeah. So again, downtrend. Same thing. What do we do now? For this price to break here, it costs so much money. So they will not allow for this lower high to be taken out, right? So what you'll be looking away, we trade out here on the bearish trend here, we trade away the highs here. We can see here the lower highs are called strong, right? They are strong here. We have strong highs and then the weak lows here, right? The lower lows are the weak ones, right? So the lower lows are the weak ones, the lower highs are the strong ones. So we trade away from the strong highs and we target the weak lows because we know that the market is moving, breaking lower lows, creating lower highs. So that's why the lower low is considered to be weak because the market is creating lower lows and then lower highs, breaking lower lows, lower high, breaking lower lows, and so forth and so forth. Yeah. You get it?
Yeah, I get it.
You follow, ne?
I follow.
So on the bearish trend, we target our lower lows. So
Target the low.
so this thing is the weak low. So this thing of, I see a lot of people, you're targeting this target which is 100 days away, 5,000 days away. It's wrong. It's wrong. You will not see progress. Because you understand, every day, I will show you when we go deeper and deeper and deeper throughout the course, you will see the market does the same thing each and every day. Let me tell you, each and every day does the same thing. Break of structure, it's either, remember, trend. If you understand the trend, you understand structure, you understand liquidity, then you are sorted. Because every day that is happening in every time frame, if you feel like the 4-hour time frame is taking too much, you can go and trade the 5 minutes time frame. But you will understand that even on the 5 minutes time frame, the movement will be faster, the volatility will be more, right? So those are the kind of things that we'll be looking at. So for me, for us intraday traders, I prefer daily 4-hour, 1 hour, or you can do weekly, daily 4-hour if you want to swing trade, right? Yeah. It's simple. So for us, it's daily 4-hour, 1 hour. That's it. 1 hour for confirmation. That's it. 15 minutes if I want that sniper sometimes because yeah, I can do that. All right. So now I'm going to talk about, we've been talking about bearish trend, bullish trend, up, down, lower lows, higher highs, lower lows, lower highs, higher lows, higher highs. We've been talking about that through and through, right? So guys, let's just take a quick water break, 5 minutes, Yana. Let me just get a glass of water, excuse me. All right. Yeah, I needed to cool down. I was on fire, guys. I was on fire. I needed to cool down a bit. Okay. So we're back. We're back. Is everyone back?
Yeah.
You're still here. Okay. So now, uh, what we're gonna talk about is we're gonna talk about trend change, right? When does the trend change, and how does the trend change? When we say that the trend is from bullish to bearish, which simply means that it's from uptrend to downtrend, right?
Yes.
What happens? What is happening behind the fact that the trend is changing? Excuse me. What is happening behind the fact that the trend is changing? So, in a bullish trend, the expectation is that the price will continue to make higher highs and higher lows, right? Higher highs, higher lows, higher high, higher low, confirmed weak. Remember, weak highs, higher low, weak high, higher high, break.
Yeah.
Remember, confirmed, right? It's going up. But the trend will not go up forever, or the trend will not go down forever. Okay? So even here on the excuse me. Okay. So even here on the downtrend is still the same thing, but it will not continue forever. Somewhere, somehow it must change. Okay?
Yeah.
So a bullish trend change is confirmed once price breaks a swing lower high to create a swing higher high. That is what we call a bullish break of structure. All right, let me show you what I mean by that. We can see here, right? We're in an upward trend. We are forming lower lows, higher high. This was the previous lower low, sorry. And then now we have a high, we have a break of structure here. It confirms the trend change. Then we have a higher low, a higher high, higher low, higher high. Remember, it broke structure. Then this higher high now, this higher high, right? It was, remember, higher highs, we call them what? Weak highs, right? They're supposed to be high, weak when price is in bulls, right?
Yeah.
But then this higher high now, what does it do? It comes and takes out the previous higher low, of which, remember, the higher low was what? Was called what?
Strong. Low.
Exactly. It was called a strong low. So now, when a weak higher high breaks a strong low, what does that mean to us? It means that now we can be having a change of trend, right?
Okay.
We can be having a change of trend or a change of character, basically, right? So when this strong high, when this weak higher high breaks this strong higher low, it confirms to us we are changing now.
Yeah.
The higher high took out the higher low. It does not need question. We are changing. We wait for a lower low to be created. We take out our fib from the higher high to the lower low. This is our trading range. Okay? This is our trading range here. Before this leg down. This will be our trading range. This will be our higher high. This will be our lower low. This will be what now? Our strong high.
Higher. High.
And then this will be what? Weak
Weaker.
low.
Weaker. Yeah.
So now what do? We trade away from the strong high. This will be a strong high when we're targeting what? Weak low.
A weak low.
What does it form now? It forms another weak low down here, strong high, and then it breaks it. We're still on a downtrend, right? It breaks it here. So now we have a lower low here. A lower low and a strong high and a weak low, right? Lower high here is strong, the low is weak. But then now what's happening? Look, the market from the weak point of the low, it breaks the strong high. Right? So in a bearish trend change is confirmed what price breaks a swing higher low to create a swing lower low. So this is what's happening. It breaks this swing higher low, right? Which is this lower high. And then from here breaking it, it created a new swing lower low. Okay?
Oh, yeah.
So, sorry man, this is for a bullish trend. This one, it breaks a swing lower high. It's a swing lower high. After breaking a swing lower high, it creates a swing higher high. So it breaks this and creates a higher high here.
Higher high.
So we have a change in trend. We are going bullish from bearish. Okay. So we're from bearish, now we're going bullish. So the bearish one here, let me see, here's the bearish one. It says a bearish trend change is confirmed once a price swing higher, sorry, a price swing higher low breaks a swing higher low, which is this one, right? Price breaks a swing higher low to create a new lower low. So that confirms our bearish trends, right? So when this happens, we know that we're no longer looking for buys, we're looking for sells here. Until something like this happens, until we have this lower low taking out this strong one, and then this happens, we know that now we're looking for buys. Okay?
Yeah. Okay.
Other than that, we're still looking for sells. Okay?
Yeah.
So now let me move on to the last, I think this will be the last part, then we can go to the charts. All right. So now here, I'm going to talk what we call mechanical market structure. So what is mechanical market structure? So what basically I mean here is that you just have to be, there are two ways that you can identify your swing highs and your swing low, right? So this is how you identify your swing high, to say, okay, this is my higher high, this is my higher low. This is what you need to identify. So there are points that I have that can help you as a starter, right? But then when time goes on, you can create your own rules, right? You can create your own rules. Okay, so the key points here are that in a bullish trend, because sometimes you can see, okay, sharp, say the market is going up, we have a break of structure here, the market breaks structure. After break of structure, what do we expect? We expect a pullback, right? Yes. Then let's say now the market is here at this first point here. Let me just quickly, okay. Say the market is here at this first point here. You can put your fib here and put your fib here and say, okay, I'm expecting the market to come here to reverse to 61.8, and you can sell counter trend here. And then the market start going up, right? You ask yourself, but that was supposed to be a higher high because it just broke structure. Why did it not come back? Okay. So that is where now it comes to our key points to say that in a bullish trend or a bearish trend, remember, we know that a swing low is the lowest point that caused the swing high. Okay? Yeah. The lowest point that caused the swing high. And remember what forms a swing high? A break of a previous what? Higher high. Hey. So now a swing low is still the lowest point. So here we have the lowest point that caused the break of structure. And then a swing high, for us to say a swing high, we need to see a significant pullback. We need to see a significant pullback to say that now this is a swing high. So for me, what I wait for here is a change of character on the smaller time frame. Because you can see that here, it's still going up, higher high, higher low, it's still going up like that, right?
Yeah.
But then here it breaks this previous higher low. Yes. So this confirms my swing high or my higher high, to say that this could be my higher high. It's going to go back to retrace to 61.8 or somewhere there, 78. Then we can go up. Or you can just count and check, for example, a minimum pullback on Euro USD on H4. To say that we're having a pullback, then this is our higher high. To say that this is our higher high, to confirm our higher high, right? On H4, we need to see at least 80 pips of pullback on an H4 time frame. Okay? Yeah. And then on the M15 time frame, we need to see at least 30 pips. Okay? 30 pips to say that this is our higher high. Right? Yeah. So we need to see that. So we don't just come there and say, okay, it broke structure. This is our higher high. Yeah, we can take out our fib. And no, that is not how it works. There, you can follow the rules, or you can just check. But then, if you are still new, you need to use the rules, right?
Yeah.
You have to use the rules to understand that for you, that this, if it's going up here, and if it's here, and this point here, if this pullback was significant, right? If this pullback was significant and then broke some kind of structure here, some internal structure, we can say that we have a new higher high.
Yeah. Okay.
Another thing that you can do, you can check if this higher high, when this trade range came here, did it come back inside our trading range? Did it come back inside here? This one. If it comes back here, this will confirm it as a higher high. If you are not looking to counter trend, right? Because sometimes it can go deeper. Once it goes deeper, you know that, okay, this is our high high, this is our swing low, these are swing high. Then you can take out your fib, and then you can just take it like that. Okay. All right. So now